Hey, have you ever heard someone say, don't choose the new tax regime, you won't get any tax exemptions? Well, that's one of the biggest tax myths. Yes, many popular deductions are gone, but here's what most people don't know. There are still several tax exemptions and benefits you can legally claim under the new tax regime. In fact, one of them is available to almost every salaried employee, and another could save home loan owners thousands of rupees every year. So, before you decide which tax regime to choose, watch this video till the end. You might discover a benefit you have been missing. Let's begin with the biggest exemption. If you are a salaried employee or a pensioner, you are still eligible for a standard deduction of 75,000 under the new tax regime. The best part, you don't have to invest any money, you don't have to submit bills, and you don't have to buy any insurance policy just to claim it. If you are eligible, this deduction is automatically considered while calculating your taxable income. Many people assume every tax benefit disappears under the new tax regime. Here's another benefit that many taxpayers completely overlook. If your employer contributes to your national pension system or NPS, that contribution can still qualify for tax benefit under the applicable rules. So, even under the new tax regime, this retirement benefit continues. Next comes gratuity. If you receive gratuity and satisfy the conditions prescribed under the Income Tax Act, the eligible exemption is still available. These are the benefits that many people forget while comparing the old and new tax regimes. Now let's look at two exemptions that usually become important later in your career. The first is leave encashment. If you are eligible under the tax rules, the exemption on leave encashment continues even under the new tax regime. The second is the exemption available under an eligible voluntary retirement scheme, commonly known as VRS. If you retire under a qualifying scheme, these benefits don't apply to everyone, but if they apply to you, they can save a substantial amount of tax. Let's move on to another exemption that many people are not aware of. If you are a Agniveer, that's a good news. Eligible contribution to the Agniveer Corpus fund continue to receive tax benefits even under the new tax regime, subject to the provision of the Income Tax Act. While this exemption applies only to eligible Agniveers, it's another clear example that the new tax regime does not remove every tax benefit. And we are not done yet. In the next section, we will look at two more exemptions that could be relevant for many families and home loan borrowers. So let's begin. The first one is, if you are receiving a family pension, you can claim a deduction equal to 1/3 of the pension received or rupees 25,000, whichever is lower. Now, let's clear one of the biggest misconception about home loans. If your house is self-occupied, you generally cannot claim the home loan interest deduction under the new tax regime. But if your property is let out on rent, the tax treatment is different and home loan interest may still be considered while computing income from house property subject to the provision of the Income Tax Act. That's why understanding the type of property you own is extremely important. Now, let's quickly clear some common confusions. Here are some popular deductions that are generally not available under the new tax regime. Section 80C, investments like PPF, ELSS, LIC premiums, and tax-saving fixed deposits. Section 80D for health insurance, house rent allowance, leave travel allowance, and education loan interest under Section 80E. These are generally available only under the old tax regime. So, before choosing a tax regime, compare both carefully based on your own income, investments, and deductions. And if you found this video useful, subscribe for more simple finance tips.